Welcome out to Trading Justice 595. I'm joined with my brother Matt Justice. This is Mark. We're going to talk a bump in the road in this podcast, talking about the recent volatility, kind of our short and longer term outlook on it. Talk about a few defensive strategies if you're feeling a little bit of pressure and want to kind of alleviate some of the pain through some defensive mechanisms. We're going to break it all down, stocks in the news, gold, break it all down. But before we get started, before I welcome in my Miami Dolphin loving brother, who is delaying watching the Dolphins game. Let me just highlight, Matt and I are on the Traders Lounge every day at Tackle Trading. We have a fantastic newsletter. It really is a great community. It is a great place to call home. Go check out that newsletter. Go sign up for a 15-day free trial today. Go read that newsletter. It is fantastic. We do a really good job breaking down what is happening in the market. Lots of information, lots of great analysis. And then come join us on the Traders Lounge. Sign up for a 15-day free trial. Go to tackletrading.com. But Matt, how you doing? And you should be proud of the newsletter work you put in every weekend.
Yeah, we really enjoy the newsletter and the Traders Report, our two standard reports we put out for our pro member community every single weekend, every single Friday night. And if you're looking for a way to stay on top of the market on a week in, week out basis with absolutely amazing analysis, but also learning as you go, because we love to put the education into our newsletter as well as we explain in great detail everything that is happening. Definitely check out Tackle Trading's newsletter for our pro members. Each week we do a technical update in both video and written terms. We look at the standard indicators of what's happening. We look at it from a different index perspective, so you have an understanding of exactly what's happening in small caps versus the growth areas of the market versus the standard S&P 500 itself. Each week I talk about earnings and make sure our community has an update on exactly what earnings transpired for that week, making sure that they have a lay of the land, go through all the sector rankings every single week, talk about the economic landscape, talk about the economic reports, go through the global markets. We like to make sure that our community is completely informed on the entire marketplace, both in terms of the written word as well as videos, because we do know traders love to look at those charts from a detailed video perspective. So definitely check out the newsletter. It's a really good read, and it's going to help you stay on top of the market on a week in, week out basis.
Yeah, and listen, we title this podcast "Bump in the Road." We also maintained our S&P ranking from last week. And now there is a synergy there between that title and that thing. Markets were down last week, right? There was selling pressure was obvious. Unless you literally took a vacation, didn't check in, you know that already. Pretty big selling pressure in tech, pretty big selling pressure in the S&P 500, even selling pressure in some areas that had held up, your average stock. Selling pressure in a lot of places. And yet we maintain our ranking, Matt. And we titled this podcast "A Bump in the Road" because you don't do those things if you have an overtly apocalyptic view of the coming months, right? Now, there could be selling pressure this coming week, right? But talk through
and not only that, I expect selling pressure to
I do as well, especially in broad index,
especially
right?
Especially early.
Yes.
Now, I also think you should be ready for any slowing momentum pivot conversation, and that's what the newsletter was all about in the technical write-up.
And I want you to spend 2, 3, 4 minutes here detailing that technical, what you just said, because I think it's important coming into the week.
The market obviously last week had a very difficult week in terms of any consistency out of the market last week, other than down, down, down. When you're looking at the heat map and you kind of look at it from a 1 week perspective, you can kind of understand kind of where was the aggressive selling pressure last week, right? Because was it across the board, right? There's a difference between a sell everything moment versus rotation. And oftentimes when the aggressive areas of the market start selling, all the markets come down, and thus everybody assumes that this is an entirety sell everything first environment. And that's not what it is. We are not seeing that. And so I want to provide a little bit of context for why we did not downgrade the market this week. We did downgrade a couple sectors, primarily in the tech space, but we did not downgrade the market this week, despite the downward pressure in price. And the reason was twofold, Mark. Number one, it was not broad-based selling. And so the market's pulling back certainly, but it's not completely in the entire market. For example, on the defensive side of the equation, when you're looking at the performance from last week, the performance from last week was actually pretty decent last week on the defensive side of the equation. And so when you're looking at, say, we'll go to the groups here. When you look at the groups here, and you're talking about, okay, what the market do last week? Well, obviously we had tech sell aggressively, energy sell aggressively, and you had aggressive price movements in industrial, finance, communication services, and basic materials last week. Those are all cyclical or aggressive areas of the market. On the defensive side of the market, staples was up last week, real estate was up last week, utilities was up last week, and healthcare is just doing a little bit of a bullish flag-based pattern. So on the defensive side, it looks really good. If you're looking at just the relative price performance last week, you would definitely look at a downgrade. There's no doubt about that. But when you look at the heat map, you can kind of see the heat map was really relegated. The selling was really relegated to the aggressive areas of the market, semiconductors specifically, technology secondarily, and then a little bit of mixed analysis across the market. Big red in energy as well. So technology and energy had really kind of the leadership to the downside last week. So when we're looking at those rankings, Mark, and we're talking about the S&P 500 at a positive 30, slightly bullish ranking. Despite the selling pressure last week, I can't not see the RSP, which is the equal weighted index. I can't see this other than a bullish retracement. And the reason I say that is, yes, the selling was aggressive last week, but it wasn't as aggressive as the buying pressure in the V-shaped recovery was. And that's my point here. Difficult week. But when you look at from the tip to the trough and you look at the percentage of the decline in against the previous upward movement in price, we are only declining 38% against the previous upward movement in price. From the time I was taught technical analysis to today, and I've been studying technical analysis for about 20 years now, Mark, I have been taught to read that as a bullish uptrend with the potential of an increasing support level. And if you have an increase in support level against the backdrop of an increasing resistance level, from 300 years ago on, that has been a bullish trend. And so you can't, I just couldn't in good conscience justify downgrading the bias in the market when the selling pressure was really just a NASDAQ issue or a Q's issue or a technology semiconductor issue, whereas the broad market itself was really just pulling back against that upward movement in price. And so I see this when I look at RSP, I see this as we're tracking a bullish retracement. That's how I see it. And when you go through the tracking of a bullish retracement, you wait on pivot formations. And the deeper you go in that retracement, the more you're going to need to see before you get confident on the buy side of the equation. And so, for example, Mark, let me just give you some examples from an index perspective. And so when you're looking at SPY here, you got a double top against the SPY. That's a little bit concerning. And so on the SPY, you don't see this as a bullish retracement on the SPY, given the fact that you do have a double top. Why is that important? Because on the SPY, which reflects the NASDAQ and the growth areas of the market a little bit more accurately, you're going to need to see a little bit more than just a pivot and go here. You're going to have to build that confidence the same way we have to build a technical pattern here. You can't just see this as a slowing momentum, pivot, upward movement in price, and then you're ready to giddy up and go again. You got to let that volatility work out, quite frankly. On the RSP, which is the exact same index, which is equal weighted, which means the tech areas of the market don't reflect a little bit more aggressively here. In the RSP, you see this as a bullish retracement because it increased its resistance level, which basically means any pivot here you're going to love. Any pivot here you're going to love. And the areas of the market you're going to like that in is cyclical based. Because when you go to the sector analysis, Mark, and you're talking about the sectors out there, you look at the technology sector, for example. You can't see technology as a bullish retracement. It's not doing that. It's got a lower level of resistance.
It's a totally different conversation.
Exactly. So the pullbacks in the market, you can't. My whole point here, Chucky, is the volatility in the market and the pullbacks in the market we're seeing, you can't categorize the exact same because the previous movements in the market were different. The NASDAQ has a lower level of resistance versus the RSP with a higher level of resistance. You're going to see the RSP, which is the equal weighted market, as a bullish retracement, whereas you see the technology areas of the market going through random bouts of volatility, going through what I would describe as symmetrical triangle based, which is really volatility based. And so, yes, the entire market did pull back last week to some extent, but not every pullback is equal, Chucky. What's happening with the momentum of the conditions going into the pullback is going to be equally as important. And when you're talking about a lower level of resistance, you're just going to violate more support levels quicker. You're going to see more volatility quicker, and you're going to have to see more in terms of the build before you get more excited. And
to put it in simple terms, on something like technology, I'm going to need a longer, almost like a multi-week 8-9 trading session support build. Whereas something in healthcare or in staples, I can have a much more aggressive entry point. I don't need to wait for the eternity to find
for anything.
Yeah.
That's the thing that and again, we can go through all the sectors and do that exact same thing, but the indexers are telling you the sector story. And you can understand that through the understanding of RSP versus SPY versus the Qs. And when you're looking at RSP, once again, when you're looking at RSP and when you're tracking RSP, you're reflecting more of the cyclical environment. So when you're seeing more strength in RSP, you see that more as a cyclical or a defensive type move versus when you're looking at the SPY, you see that more as a aggressive type area of the market. And so with RSP looking a lot better in this pullback because of the previous upward movement in price, you do look at that as a pivot and go type scenario, which means all you need to see on RSP, which again reflects cyclical and defensive, is a doji upward movement in price, and at that point you feel a little bit more comfortable on the bull side. When I'm looking at the SPY, given the totality of the analysis, you need to see more than just a doji upward movement in price because there's more volatility here due to the reflection of the NASDAQ. When you are looking at the NASDAQ, you need to see a reversal. You need to see a reversal. And so this is a concept that I teach at Tackle Trading to our pro members, and we talk about it all the time. And it's called the depth of the retracement. And the depth of the retracement matters because the deeper you go in your retracement, you're going to need to see a little bit more build from a pattern development perspective. And so right now, I think you got some concern on the NASDAQ. I think you got obviously some concern on the SPY that reflects a little bit more of the NASDAQ. But in the RSP and in the general market, I'm just not seeing the chaos from a technical perspective in the short term that I'm reading from people on Twitter, Main Street Financial Media, other financial podcasts out there. They're all painting this environment as the last nail in the coffin of the bull market. And I look at RSP and I'm like, maybe there's obvious concern out there. We're going through an interest rate conversation on top of an economic slowing growth conversation. There's some concern out there, but I don't know. We haven't even broke the 50-period moving average on the daily chart yet in RSP. I don't think we should get too overtly concerned in the sky is falling until we're no longer talking about the hypothetical increase of a support level against the backdrop of the market itself. And so tough environment. Never want to catch a falling knife, but I also recommend treating this as a pullback scenario in RSP, treating it like a king's bed scenario in the SPY, and treating it like a reversal scenario in the Qs. And that would be my strongest recommendation. And if you don't know how to do that, I invite you to come over to Tackle Trading, sign up for a pro membership, read the newsletter, watch the newsletter video so you fully understand the entire analysis, and then sign up for the upcoming Master Trader course where we're going to teach you in detail how to actually do it.
Yeah, no, and it's one of those things when we talk about a few defensive strategies in a second, some portions of your portfolio are going to require maybe one strategy, and others, like let's say I had a healthcare stock that's just pulling back. I don't want to do aggressive cover calls in those type of stocks. It's going to just in a case by case basis, but we'll talk about that in a second. And Matt, we have an increasing macro conversation on. I know from this week's price action, it felt like the debate was decided that the economic data this week must have been so apocalyptic that recession is here and it's on our doorstep. The plain and simple fact is that is not the case. Like many weeks we've had recently, you could sum it up with, are there worries? Are there concerns? Are there things that point to slowing growth? Yes, there are. Are there apocalyptic, oh my goodness, it's upon us? Not even close, right? You know, you have a lot of mixed reports. You have some downright services data, which is a huge section of the economy, dwarfs manufacturing, like by a significant, coming in, like saying, hey, not there yet, bears, on a recession. You know, and yet the conversation.
Services versus manufacturing. We are a service economy that wants to embrace more manufacturing. That's what we are trying to build into, and that's regardless of political party. I think post pandemic, I think that's a nation state issue, not a political party issue. But we are a service economy that wants to bring home more manufacturing to the States.
Yeah, Matt, and it is one of those things, when you look at the data this week, once again, heavy selling pressure on Tuesday, heavy selling pressure to end the week, right? And a lot of causal links were said, well, manufacturing data was terrible. The unemployment report on Friday was terrible. Neither were terrible. Neither were great. It's almost like
in describing the accuracy of anything in an election season. That is what is going on a little bit here.
You know, and
people are taking small beats or small misses and they're running with it from a messaging perspective. It's hard to decipher in election season truth of anything. It just is. When you're looking at the economic landscape last week, it was a really big economic week. We had services data, manufacturing data, but at the end of the day, it was all about labor market data last week. And when you're looking at the environment, this really started selling on a manufacturing miss on Tuesday of this week, right? And where it came in at 47.2 versus 47.5. Well, Mark, when you look at that economic data, that's not abnormal on manufacturing. For the last 18 months, as we've been going through this economic conversation, that's where the manufacturing data has simply been. That's not going to, 47.2 is not going to inspire anybody, but it's also not going to be chicken little, the sky is falling, given the fact that we've been staring at that type of data in the ISM manufacturing for literally 18 months. One thing to be clear on, though, Mark, remember what I said just a couple weeks ago when the Fed declared victory on the inflationary front. What's going to become more sensitive on the algorithms? The ISM manufacturing data, the labor market data, anything that is extremely sensitive to the economic landscape, that's going to be a little bit more volatile. And so I do think we had that a little bit coming through an extended weekend. And I also think there's just some concern in the environment as well. But I wouldn't say the 47.2 versus 47.5 was apocalyptic from an economic perspective.
None of this week was apocalyptic.
When you get ISM manufacturing prices that actually went up. You got the JOLT report, which gave a healthy dose of a scare on the labor market on Wednesday. They came in with the lowest job openings that we've seen in a while, Mark. Like the last time we saw this type of handle was all the way back in 2021 when we saw basically the jobs come back from the pandemic, right? And so the
But
pandemic
once
shut
again,
down.
I would like to point, and I wanted to make this point in the podcast, coming back to normal levels.
We're still above the job openings of 2019, 18, 17, 16.
2017. These were extremely decent economic environments.
Yeah.
And so when you look at things, you can look at a normalization, and a normalization,
Great word for it.
You know, a normalization of economic data from some basically pandemic anomalies.
Okay. And
but it is so not important. Apocalyptic.
Yeah, I agree. That context is so important, because if we're comparing the job openings post-pandemic
to the height of monetary loose policy,
coming back, right? All the jobs were coming back. So, Mark, all those jobs that were lost during the pandemic, they all came back in 2021, right? Obviously, job openings are going to be historic in that environment when you're coming through the pandemic. But, Mark, that's not going to always be the case. We're not always going to get that gift in 2021 of all the jobs coming back. The normalization of the labor market, that should be the thesis. That should be the theme. But that's not what the conversation is in the market yet. That context is for kings, and that's going to play a role down the road, because this is not an economic apocalyptic situation. And that context matters to the market. And
we are not, we're not having an earnings recession.
But the
we're not
having. Doesn't matter on the day a report is released. It matters as we start seeing the prices get lower, and we're all start thinking, wait a second, if the economy's not going to burn here, and the market's going to sell aggressively like it did, this is a buying opportunity in the intermediate time.
Yeah, listen, if you want to have, and this has been our stance at Trading Justice Podcast for a long time, you want to have a stagflation conversation with us, we're totally open to that.
That's my base case.
Yeah, you want to have that type of conversation. You want to have an apocalyptic recession coming conversation. Matt, I do not believe you can have a recession when GDP, when the amount of money we spend in this government.
Right now, guys, I don't know why we're having the economic recession conversation, other than the fact that I do believe there's entities that want to have an economic recessionary conversation.
Yeah.
I don't understand that conversation as of right now, when people are anchoring in that conversation against the labor market, when the labor market has, or job openings at 7.67, which once again, coming from the heights of the post-pandemic recovery, is not a good number, but coming from any moment in time throughout human history is a really, really, really big number. And so I do think the context is important there. But again, it was
Matt, in technical terms, you're just pulling back to the old breakout level.
We're getting through the pandemic recovery. We are getting through the pandemic recovery there. Initial claims on Thursday came out in line. ADP non-farm was a big time miss on the labor side on Thursday. That was obviously some negative information. And then on labor on Friday itself, Mark, this is about as a mixed report as you're going to get.
Just flat out mixed.
Friday. There's positives to it. There's negatives to it. The positives, the actual unemployment rate came down to 4.2 from the 4.3 level. Average hourly earnings, which wages right now are outpacing the rate of inflation right now. Average hourly earnings up 0.40. If and this is a big if. Remember, the Fed's declared victory on inflation. If that's not me declaring victory on inflation, the central bank has declared
and Matt, I know this might be weird, but I think 12 months from now, we're more likely to have a inflation resurgent conversation than an economic depression conversation. So
1,000%
12 months from now,
1,000% accurate. That is 100% accurate, Mark. In 12 months from now, I would say the probability of us having another double dip inflationary situation is higher than the probability of us having a recession. I would suggest that. And I'm willing to bet if you asked most Americans, they would agree with that as well, that they're still more concerned on the inflationary side than they are the economic side. Even though most Americans see it as one and the same, I would say they're more concerned about price cost than they were about losing their job. Would you agree with that?
Yes.
Okay, so it's the central bank that has declared victory on inflation, and I want to be very clear on that, and that's how I describe it, because I don't think we should have declared victory on inflation, but the central bank certainly has, or they would not be entertaining a cut in just 2 weeks from now. So the rate itself, the labor market number was mixed, right? Average hourly earnings, wages going up. We did see a little bit of a miss on the actual forecast, 164 down to 142. Last month was 89. I think the biggest problem in the actual data over the week, Mark, was the revisions. We keep seeing labor market revisions to the downside.
Oh, make no mistake, we got softness in the labor market from where we are. That's not a debate there right now, right? That's not a debate there right now.
And we should continue to see a little bit of softness in the labor. Yes, 100%.
All right.
What about
so
this week?
Let's speed through here. Let's not spend too much time here, because I have a pace that I'm trying to keep us on track of. Not the big economic week that we've had last week on the number of total things that can cause algorithmic movement. The ones we do have are inflationary by their nature. Yeah. Now, could you, because markets are in flux, could you still see some wild movement one way or another? Of course you could, right? I mean, everything is economically sensitive.
I got a hot take here, though.
Okay, give me your hot take.
Okay, no, finish your thought.
No, but I was going to say you don't have as many total data points here to cause narrative changes.
No, you got 2 data points. You got CPI and PPI. That's what you got this week. It's actually a
especially since unemployment claims refuses to budge from its range. So
I think the way the forecast, and this is my hot take a little bit, I think the way the forecasts are working in the market this week, it's built for the bulls. And the reason I say that is the previous CPI report came in at 2.9% year over year. The forecast is to come down at 2.6, which means we're not sniffing the 2.9 number, which means in any scenario,
headline perception.
In any scenario, the perception of inflation should get better this week. Okay. So the year-over-year numbers, even on a miss on the report, meaning it comes in at 2728, right? Even on a miss on the report year-over-year numbers, you're still underneath last month's numbers, even on a miss. And that's why I say in this pullback scenario, with the market pulling back as it is, I do think the CPI report has an edge to the bulls this week, given the fact that the forecasting numbers is significantly less. You might say 2.6 to 2.9 is not. We're talking year-over-year inflationary numbers. That's a significant difference. And so 2.9 to 2.6, like even on a miss, I could see the market saying, "All right, it's better." And so you would have to have a substantial miss, in my estimation, to see the continuation of this sell-off. And if you did see a substantial miss, you are not having the interest rate conversation you're having. And so I do think the CPI report is kind of built into the market a little bit this week on the bull side of the equation. We'll have to see how that works out.
Yeah, and we also have a presidential debate on Tuesday night, which will feed into Wednesday's action. So like the cumulative, like, and you might see, who knows, some policy discussed or this or that, who knows, right? But that is like, well, you'll have words said. Okay, words will be said on Tuesday night. How markets interpret them.
Policy debate on Tuesday night.
Funny. Anyways, my point being,
I want a policy debate. I hope
Wednesday morning when
I'm still on this policy debate.
Okay, listen, we got to keep on track.
All right,
we got to keep on track. All right, so let's get to stocks in the news. I think
America knows what a policy debate is anymore, by the way.
No, let's spend money. That's why you're not having a freaking recession, because the only policy debate that Americans agree on is spend lots of money.
The Uniparty agrees on one thing: we spend money.
Yes. So, all right, let's get to stocks in the news. 5 stocks. Matt doesn't know what they are. The 5 stocks I found the most interesting from a news perspective this week. I'm going to start off with NVIDIA. Let's do this rapid fire style. We still got some things to cover in this pocket. So just rapid fire style. Give me your quick take on it. Yep. NVIDIA had news. They said, hey, remember NVIDIA had on Tuesday, oh my goodness, we're getting subpoenaed by the Justice Department. And then by the end of the week, they've said,
Tuesday, there was a rumor coming out that they were under a subpoena from the Department of Justice. Everybody in the world criticized the Department of Justice up until Wednesday, when NVIDIA came out and said, we contacted the Department of Justice and we are there's no subpoena out there, which means I think there should be other subpoenas for whoever put out the rumor of a subpoena on
and
NVIDIA.
make no mistake.
There is market manipulation on this
Make
one.
no mistake. This week, this entire week got fueled by the leak of that on Tuesday.
1,000% accurate. Somebody should go to jail for this one.
Why did the market sell off this week? It wasn't because of economic data. It wasn't because of increase. It was technical.
Mark, $1 trillion exchanged hands this week on that rumor. Somebody needs to be held accountable to that nonsense. If it is not true, and if the Department of Justice was not preparing a subpoena, and there was no smoke under that fire, and somebody was just putting that rumor out there to see a market sell off because they were short going in, they should go to jail.
They did. That is, I am convinced that is exactly what happened this week, is that you had the rumor leak. NVIDIA went down 10% on Tuesday. That just doesn't happen because
there was no news on Tuesday. But listen, rapid fire take. This needs to be investigated. The SEC needs to get off their lazy ass, and England needs to do something for the first time and investigate this NVIDIA news story. We were all there. We all saw it. It wasn't the Wall Street Journal. It was Bloomberg, right?
It was Bloomberg that leaked it at the end of the market, but obviously people knew it was coming.
There was some leaking happening.
The price action on Tuesday was really weird.
It was violent. It was violent out of nowhere. And the news was nowhere. Everybody in the market Tuesday morning was like, why is NVIDIA gapping and selling as aggressively as it is? We didn't know until we saw the Bloomberg report, and then we're like, oh, that makes sense now. And then the next day it's like, wait a second, what is going on? Again, my only take here is, number one, NVIDIA had a better than what people are talking about at this point. They had a much better earnings report than what people are. It's almost like NVIDIA's down, so people just assume NVIDIA had a negative report. They didn't. They pulled off a hat trick. They increased guidance. And the lower these things go, the more I'm going to look at it.
And this is going to be this is going to be an important stock to watch for bottoming formations. One of the few times in the 15, 16, 17 years, however long I've been doing this, where an individual stock has macro bottoming formation potential.
And I would not be surprised if we start seeing a little bit of support build here around that $100 price point on NVIDIA either.
All right.
I like it. What's the
second stock? Dick's Sporting Goods, DKS, because once again, because one of the jobs I have as a manager of my portfolio is like, all right, do we have the environment for a big bear, right? Big bear, downward price action. And you look back at the things necessary for a big bear. One of them is earnings recession. That can obviously do that. And so I am on the lookout for, signs that something's happening. Matt, I keep seeing retail company. Now, for every retail company I have that come in, I have one come in that I'm like, oh, that wasn't too shabby of an earnings. Yes, downward price action would make you indicate that the stock had a terrible earnings report, and that I thought the earnings were pretty good, showing another kind of like Best Buy the week before, that the demise of the consumer entirely a little premature. What was your take on Dick's earnings?
This was a good report out of Dick's.
Yeah.
Quite frankly, retail's either been good or bad. Like from an earnings perspective, either you were good, beat, increased guidance, or you missed, decreased guidance. I really have never seen anything like retail in this earnings season where it was either really good or really bad. There was no in between on the retail side. And Dick's came in with a 15% beat, 8% year-over-year growth. They beat both on the EPS and the revenue side of the equation. They also raised forward-looking guidance here, Mark. This is a hat trick.
And that's why it made my top five list.
If it wasn't, it made the Bull Quick Hit list on, despite the gap down, it made the Bull Quick Hit list because context matters. Again, I always say this, context is for kings, but context matters in earnings analysis, Mark. The environment matters, number one. This was a horrific week to report earnings in. From Tuesday morning with the NVIDIA news on, this was a horrific week to report earnings. If Dick's reports earnings 2 weeks ago, Dick's is up 8% on the announcement. Second thing in the context of an earnings analysis, where you're at in the short-term trend. Has the market front-run your earnings report? has it sold your earnings report going into it? If you're at the low point, you're usually going to be seen with a little bit of rosy-colored glasses on. If you're at the top point, you gotta really inspire people on the growth side of the equation. And then the third thing is, Mark, oftentimes, regardless of the numbers that do come in, regardless of the environment, regardless of if you're at the top or the bottom end of a trend, sometimes you just have big institutions who decide to get out of a position, and they use the earnings analysis to get out of the position, or in part to get out of the position, because there's so much liquidity in those environments where you have massive volume there as well. And so there's a lot of context when it comes to earnings. To make it simple, you were elevated in price, you had a beat, increase in guidance, you got caught up in the market, but I like Dix here, and I think you treat Dix as a little bit of a support build. But again, you're going to have to see a little bit more than just a pivot and go here, because you've given up so many moving averages. I would put this on any reversal watch list, any King's Bed watch list, anything. The moment that gets above that 9 EMA on the downside, you're going to like it a little bit more. But I would agree with you.
All right, let's keep moving around at a more rapid pace through these next three. Broadcom, AVGO. Report came in. The report is all right. They did decrease guidance. It just let me know, in this market, you got to be careful with individual stocks going into earnings super much, and be aware that earnings happen even when it's not earnings season, right? Stuff like this.
Another gap down here, but Broadcom didn't make my bull quick hits. It made my bear quick hits on Broadcom, because not all gap downs are the same. Gap down, sell down behaviors are not good. They take a little bit of time to work out, but Broadcom lowered guidance, Mark. And the biggest problem with semiconductors right now is not the fact that they're not making money. They're making money. They're making so much money right now. I mean, they don't even know what to do with all of it. It's not that. It's the growth side of the equation. Remember, people are willing to pay premium for semis. People are willing to pay premium, meaning PE ratios, for technology, but it's got to have those growth kickers. I just think you're missing a little bit of that component right now with the lowering of guidance out of Broadcom. So I'd be a little concerned, but if Broadcom's your thing, you're going to certainly cheer on that 200-day moving average.
Unipath made my list because, in the midst of, I'm not going to be doing much in the market this week. One, they're managing existing positions, going to wait for technical patterns, this and that as a general rule. But while I'm doing nothing, I'm always doing something, and that is building watch lists of future plays. I thought the earnings report was decent. And I like stuff where you've had huge, massive sell-offs on stocks that I find interesting, where bottoming formations could develop in the coming weeks. And that's why Unipath made my list. It clicked a lot of boxes for me.
Unipath had a horrific earnings report where they lowered guidance last quarter, Mark. And this is something I talk about quite often. We've seen it out of Starbucks recently. We've seen it out of Nike recently. We've seen it out of multiple companies. Specifically last quarter, we saw it. Companies that just give in to the guidance. They just basically say, okay, we're going to rip everything up right now. We're going to put all the bad stuff into our report right now and just let the market just puke it all up so that we can rebuild, right? And that's kind of what Nike did. That's kind of what Starbucks did. That's kind of what Unipath did last quarter. This quarter, Unipath came out with a 33% beat. I believe the revenue handle was right around the 10% number, and they increased forward-looking guidance. So not the hat trick treatment, but that increasing forward-looking guidance was really, really big. And then the price response also told me something on Unipath. And this is an AI name, growth stock as well. It gapped up and started running right into 14. Then it started selling immediately right as it hit 14 with the marketplace. That kind of tells me where the important price levels are here. And so if you like the Unipath earnings report and you like the bottoming formation, I think you're also going to like it when it gets above the 20-period weekly moving average.
Yeah, absolutely. The last one's a little bit of a cheat. No stock news this week. Oracle, but they do have earnings this coming week. And whenever you get bearish conditions in a space, right, I'm going to break out. I'm just going to call it my McDonald's signal. I'm looking for a report that should sell off that doesn't sell off. And then with Oracle, because of its nature and leadership, I'm just looking for actual what's happening in great tech companies on a raw numbers, because maybe you get a beat, and you're like, oh yeah, another report that's pretty decent. But probably the earnings report of the coming week that has the most interest for me, Matt.
Yeah, I can understand that. It's in the tech space, obviously. It's kind of right there with a lot of the other names out there, and so will we see a behavioral difference on some of these earnings reports out of the tech space this week than we did last week, right? Because the week before it was a good week. Last week it was like the worst week to report earnings on in the last month and a half, and then this week obviously could be a little bit of a different environment. Can I match you one? Can I match you one?
Yes, let's do it.
I just have one. Just on my from an earnings perspective. ASO, Academy Sports. Academy Sports, in my estimation, one of the better retail companies out there. Mark, there's just a good report here could create a confirmation of a head and shoulders reversal formation, and so I just wanted to put ASO on the radar. A positive report that gaps up above 57 would be really positive for any secondary pattern watch on ASO.
Let's just, before we get into a little snapshot of some defensive strategies to put on your radar, let's go take a look at the dollar and gold real quick before we do that. Dollar has some bottoming formation possibilities here, man. That obviously has ramifications in multiple asset classes if it does. I wrote the dollar write-up for the newsletter, and you're my currency guy. I always call and say, is this your take on the dollar? And you're like, yeah, that was my take on the dollar. What's your take on the dollar? Because it's my take on the dollar too.
I mean, my take on the dollar is really simple, Mark.
Yeah,
it's got a lot of bearishness coming into the 100 to 101 handle. That's kind of where that massively important support level is. And I think it's going to be hard to break. I do. I think it's going to be hard to break. The analysis going into it would suggest that a break is I would say, a likelihood. And the reason I say that is on the daily chart, like you got momentum going into that. And so you do have momentum going into that. Look at that momentum on that third leg here. Just really good momentum. The retracement was consistent. I haven't been real surprised in the analysis at all on the dollar recently. And I also wouldn't be surprised if the probability shifts to support holding at the 100 to 101 level. That is a really, really important support level, not only from a technical perspective, but also from a fundamental perspective. And anything underneath that level could trigger some really, really interesting situations coming out of the central bank who may be forced to protect the dollar a little bit, Mark. And that could offset some of the interest rate cuts they're looking at making. If they get concerned about the dollar, the only way to protect the dollars is to not cut rates or to raise rates. That's how you stave off anything coming down. Secondarily, in the back of my head, though, the market has a tendency to price everything in, and the central bank then has a tendency to overreact to that pricing in. So I hope we just kind of let this one play out. But in general, I got a lot of respect for the 100 to 101 level, Mark. I expect some battles to be had there.
Yeah, going over to gold real quick. Having a hard time breaking resistance, but it still doesn't want to bite. Had other intraday things this week where it could have continued selling. It just doesn't want to do that. We've seen that all year. Still struggling with a resistance break here. What's your technical look at gold? Obviously, long term,
short-term
we love
range
it.
we've had in gold for a while here. You obviously like gold long term. Nothing changes there. And if you're looking at anything on the top side, you obviously are looking at this pivot point here, right around the 2565 level.
Yeah, indeed. All right, so we got a little bit of market volatility. Bump in the road is how we're looking at it. Until I get an earnings recession, until I get macro concerns on something. Respect pullback. I think you did a fantastic job on the technical aspect. But, I'm always on the lookout to play defense. I like my defense first kind of guy, protect my portfolio. Most experienced traders do, right? Like they're like, oh, now there's a lot of ways you can quote unquote protect your portfolio. You can go aggressive and buy puts and load up on bears, right? Or you can use more subtle strategies. And I would like to talk about 3 subtle strategies today. I'd like to talk about the covered call, a different version of it in the money covered call, which we did a little write-up in the newsletter this weekend. And then I would like to talk about something simple, just taking a few bearish trades, something that some individuals have a harder time doing. Let me count that. But Matt, just from a covered call perspective, you asked me on the Traders Lounge this week, is this a time to go get super bared up, or is just cover calls using those techniques defensively? And I aired on that, still remain in the use covered calls, use, those type of elements to protect positions more than anything. Now, there are different ways to use covered calls. Matt, talk about how you use covered calls from a technical perspective, first and foremost.
Well, let's take a tackle 25 stock here, one that looks fairly similar to the market itself. Nice little V shape coming up into that high there at 50 pullback analysis. Okay, so when you're looking at a risk graph, and that's what I mean. This conversation is a good conversation, Chucky, but at the end of the day, we look at these things on a risk graph. Period. End of sentence. So let's say you have 100 shares of General Motors, right? And you just own 100 shares of General Motors, and you're a little concerned about the environment. Okay, so let's just make this really simple, 1-to-1. You could own 1,000 shares, you could own 1,000,000 shares. The conversation is very similar. So let's say you own 100 shares, and you have some concern that the stock is going to continue to go down because of what the market's doing right now, or you think the market's going to have some increased volatility, or you think the market's going to start pricing in a recession, or whatever the case might be, right? You're concerned and you want to guard against that concern. The first thing people have a tendency to do in these environments, Mark, and it's unfortunate because they don't understand one simple concept, is they have a tendency to run to the options market, and what their first reaction to do when they get scared is they buy a short-term put option. And when they buy that short-term put option, what they don't understand is there's people like you, Gino, Coach Greg, and a billion other traders out there that are more than willing to sell them short-term insurance. That's the first thing people have a tendency to do when they learn about the options market, is they buy a short-term put option to alleviate some of their concern. But that's all they're doing, is alleviating some of their concern. What they're really doing is paying my brother Mark a little bit of cash flow to act as the insurance company. Because what they don't understand is they come out to the short-term market and they're fighting volatility by buying that put option. When they're fighting that volatility by buying that put option, volatility is going to work against them. And then if the volatility doesn't play out like their concern in their head does, volatility therefore works against them, time works against them, and whatever they spend on the insurance position is obviously just wasted money, and it's cash flow in your account, because as the put option writer, you love people that get emotional about the market, that run to the put option side of the market and just buy put options when they don't understand how volatility works, and obviously short term is going to run into a bunch of theta problems. The better thing to do in that environment, in that concern, is to make volatility work for you. Instead of going to the put option side where you're fighting volatility, you want to go to the call option side and use that volatility and sell a covered call. And so when you're looking at the risk graph here, if you were to buy a short-term put option, let's say we buy that short-term put option right there. Well, if you were to buy a short-term put option, it does flatline the risk graph. There's no doubt about that. You're flatlining the left-hand side of the risk graph. But that's only if you exercise your right to sell the stock at that strike price. That's not what you're doing. You're just trying to protect. You're going to lose that money, quite frankly, because of volatility and time. And so it's much, much better in that environment than instead of buying that put option, instead of doing that, come to that 30-day number, whatever that 30-day number is, and then just write a covered call. And how aggressive you want to be in writing that covered call will determine how concerned you are about the market itself. If you're not overtly concerned about the market, you would write a 0.40 delta to be a little bit aggressive on the covered call side of the equation. If you wanted to be very aggressive in locking down that risk graph, you would do what's called a covered write. And Mark, that's what Coach Gino wrote about in the Traders Report this weekend, was, okay, if you're concerned about the marketplace itself, instead of fighting volatility, start understanding the protective covered call, which is known as the covered right, which is a covered call that we sell in the money or at the money. And so what Coach Gina would say, what I typically say in this environment is sell a 0.40 delta that's slightly out of the money, but you're taking advantage of volatility. What Coach Gina will say is, if you're really concerned in the short term, sell a 0.50 delta, an in the money covered call, and then you're bringing in a little bit more cash flow to offset that. And as volatility declines, well, guess what? Now volatility helps us, it doesn't hurt us. And so it's really a conversation initially on whether or not you want to lock down the risk graph, i.e. the right-hand side of the risk graph with a covered call, or whether or not do you want to lock down the left-hand side of the risk graph with a put option. And to me, the first thing you need to do is to lock down the right side of the risk graph. Use that covered call to lock that down, bring in some cash flow, and then if the data plays out, then let's entertain a insurance conversation. But I'm fairly opposed to buying insurance in the market in a pullback scenario. In any
I am
scenario,
in fact, Matt, I'll tell you something I did with some SPY positions I have. Like, right, market's going up, whatever, volatility is cheaper, I'll put puts on to protect. But as you had market volatility this week, I monetized the puts, the long puts, and I went deeper in the money cover calls. Mm-hmm. These reasons, right? It's like, it's like still defensive, right? And based on your conversation on technicals, a little more apprehensive, jittery on the SPY for the next couple of weeks than make
everything until we get a pivot, like everything.
Yeah, and so more jittery there, and so went for a little more defensive measure. But my defensive measure, Matt, actually involved monetizing my long puts and going in the money covered call for those reasons you outlined.
On the covered call side versus the put side, because those are the insurance conversations. So outside of like sector rotation models, making sure you have gold and all that jazz, right? But we're covered call versus put option.
Well, we're trying to do a defensive segment in 10-15 minutes that we have with our pro members.
Would you be surprised if the 20 period weekly moving average holds on the SPY this week?
I will always say that you have to give the benefit of any moving average the benefit of the doubt.
Because if it does hold and you have a doji on the weekly chart, I promise you every technician in the world will start analyzing the market as a cup and handle continuation pattern. And if that's the case, you don't want insurance in that.
Yeah.
Because you will lose money on your insurance on that. And then when you lose money on your insurance, you'll probably make a whipsaw decision on the other side of the equation. It is infinitely better in these environments when we're having a debate on if this is an M formation or if this is a cup and handle, because technically that's the long-term conversation right now. Is this an M formation at the top with the double top, or is this a cup and handle formation giving us a continuation? I'm telling you, Mark, I'm not going to pat myself on the back, but I did write the book on the art of the reversal. I don't know yet, because you don't know at this point until you see a pivot. That's why I say it's so important. If you get a doji this week, I'm going to be breaking this down as a cup and handle continuation pattern. Whereas if I see that 20 period moving average get weaker this week, I'm going to be breaking this down as an M formation. That's how I see the market in reversal versus continuation. You don't know until you see what happens with support. We know resistance held against the double top against the spiders. We don't know about that M because it has to come down to 510 to give us that M formation. In these moments, it's infinitely better to control the risk graph through covered calls than it is put options.
It's just easier. It's just easier. Like it's easier to navigate.
Money on the covered call side.
I mean, because that's the thing is that let's say my decision to go in the money covered calls and remove the puts, and the market just takes off, V-shapes again. All right, well, I'm going to be able to make money. I'm not going to lose money. But if I go heavy puts scenario, then
you're done on the puts. You'll lose money on the puts because anything back up quick. those puts get smoked.
They get smoked. And so, like, I would rather, because I want to play some defense, I would rather do it through an in-the-money covered call on bigger instruments. Now, other instruments, I'm still happy doing out of the money covered calls. Like
insurance conversation on the market is a really, really important one, because it goes back to times of subprime meltdown, dot-com meltdown, and making sure those retirement accounts don't get cut in half. That's the insurance conversation, because people spend a lot of time and a lot of resources building their retirement account. And the old joke of a 401k going down to a 201k was an old joke for a reason, because there was a lot of truth to it.
I will never let that happen to me. I won't.
That happened in 2008 to a wide...
so many people.
So many people. Same thing in 2000. And you know what, Mark? The next market crash will do the same thing to a bunch of retirement accounts as well. There's so many times in the market where from 2008 to 2024, we've had moments of concern in the market. So many. Mark, if we spent a podcast just detailing the concerning moments in the market from 2008 to 2024, there would probably be 75 data points, and we would probably be talking for 75 hours. There's always some concern in the market. And if people, every time they get a little spooked by market volatility, rush out to buy put options, they're never going to have a retirement account in the first place, because they're just going to lose money on short-term insurance all the time. It's not a wise strategy to fight against volatility on the put side. It is infinitely better in these conditions of reversal versus continuation, because that is the entire conversation right now. We can talk about it economically, fundamentally, but at the end of the day, the most important conversation is, are we reversing or are we continuing? And we will not know unless we see support increases. And so if we pivot point here, boom, we're looking really good. That's why I wrote the newsletter the way I did, because this concern gets alleviated very quickly if we pivot and go. And so it's one of those conversations. But in the moments people get concerned and they understand the options market, it's a mistake to run out and buy put options in moments of concern. The reversal scenarios where you buy insurance, Mark, is actually in kiss of death patterns. It's in bearish retracement analysis, not bear breakdown analysis. Because in bearish retracement analysis, volatility comes down, allows you to buy a put option at a much cheaper, and then as volatility goes back up, it helps you. But in breakdown analysis, volatility is already high, and so you're fighting it. And so in these moments...
That is an excellent point, and one we will have to build upon in future podcasts, because you just explained when to buy puts.
Yes.
In various conditions. One could argue you should have a little bit of protection at all times.
Buying a put option in a bear breakdown is asking to get your teeth kicked in.
Yeah, just markets are way too tricky for that.
Insurance as well.
And the other thing, so, if you want to listen, one of the things, we do a few things extremely well, and one of them is understanding covered calls. I doubt you find as many traders with as much combined experience and knowledge on one subject with covered calls as anywhere in the world. We do it fantastic. We have a lot of knowledge.
You won't find anybody in the podcasting, YouTube space, in the financial education space that will teach you as much about covered call analysis as we do. We anchor against it. We have systems specifically on it. I'll put the Tackle 25 covered call system against I'll put that up against the performance of that system against any Wall Street institution out there.
So we wanted to touch on a few of the main points here. The only other thing I'd like to add before we wrap up the podcast is that we have a traders report and we have bear picks. Now, one of the things I like to just do a sermon to traders, right? There are a lot of us, and I will be one of them. I was a notorious perma-bull, refused to do a bearish trade for years. I just want to do it. I would manage through my...
You managed to basically this conversation.
This conversation right here, these type of conversations.
Cover call, how aggressive on the cover call, blah, blah, blah.
And over the last few years, I've tried to broaden my horizon, and it really helps. Like, even if you are I'm a bull kind of guy or a bull kind of gal, learning and being willing to do a few good bearish trades, right? You don't have to go be...
This is the kicker. Yeah. it's I don't embrace the insurance conversation in the market because I embrace the hedging conversation on the bear side. And what I mean by that is I don't recommend buying put options on the market in these moments in time because of the volatility, because of the concern of whether or not we're going to see a technically pivot point here. It rinse and repeat the entire conversation we had. But Mark, I love having bear hedges.
Just having a couple bearish trades, right?
I love having bear hedges.
It can make the world of difference. And psychologically, having some winning positions.
Oh my goodness. Bear hedges allow you to, like, whereas people are getting crazy about the volatility last week. Yeah, as a perma bull, last week wasn't fun. It was a big time management conversation. It was a big time covered call conversation. It was it was not fun as a bull last week. You can't paint that picture as a
Matt, I did zero new bullish positions last week. Not a one.
It was all management and patience and management and patience.
Because I'm managing my existing positions, right?
You know what I didn't have to do? Manage those bear trades going into last week. And so I just think it's important. And whereas on the insurance conversation against the market, you're always going to have to be dealing with volatility. On the bear hedge, it's more just a swing trading conversation on trading a bearish trend. It's just embracing short-term trading on the bear side of the equation the same way we do on the bull side of the equation. And so every single week for the Traders Report, we have the best stocks in the marketplace from a pure technical perspective. These are not recommendations. These are watch list candidates that we share with our community. And so this week, for example, we Kimor CC breaking down on a momentum trigger underneath 18, Boeing triggering underneath a massively important support level, Lyft, which was my rapid fire favorite bear pick with confirmation underneath the low of today. EL, I believe, was one of your favorites on rapid fire with the violation of short-term support. CRISPR with the violation of support. 5 and 9 violating a massively important 30 handle. Ben Franklin, sorry Ben Franklin, but you're not looking good right now. Solar Edge, we've had Solar Edge on our bear watch list for so long, but we haven't had it on in the last few months because of a little bit of concern about bottoming formation. Well, guess what? That concern is over as you're violating support. That looks pretty good, and then Intel just can't get from out of itself, and they're violating support. So on the three levels, Mark, in these moments in time, I like covered calls against the market, against long-term asset classes, covered calls, right? And in the short term, instead of buying put options directly against the SPY, I actually think it's better in these. Are we reversing? Are we continuing? I think it's better to look at individual strategies instead of the index itself.
Yeah, absolutely. So I thought this would be a good little power segment on a week like this. But let's wrap up the podcast, Matt. Matt, give us some thoughts. Send us out. Tell people to hit that like and share button. All of that good stuff.
Definitely. If you enjoy the Trading Justice podcast, best way to help us out is give us a like and share on any platform you are watching it. We upload it directly into YouTube, obviously, Twitter. We put it out on Facebook as well. We know everybody has their favorite social media platform they like to scroll on and waste some time on the same way I do. So we like to put out the podcast on a lot of different channels. Best way to support it, whatever channel you enjoy it on, like it and share it. Tell a friend about it. Help us spread the good word of the Trading Justice podcast as well. And if you're ready to become a pro member of Tackle Trading, the best way to do that is to head over to tackletrading.com, and you can sign up for a free 15-day trial to test out all the goodies we do at Tackle Trading, including the newsletter, the Traders Report that we put out there for our weekend, for our community every single weekend. You can register for Master Trader, which is a 2-day training we put on every single month to our community. It's free for our community. Live training. Coach Gino, myself teach that course. A lot of amazing opportunities over there at tackletrading.com. So head over to Tackle Trading and sign up for a free trial and see what all the fuss is about. With that said, I hope everybody has a wonderful, wonderful rest of your week.
Have a great week, everyone.